Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Tuesday, December 6th, 2022. Still having struggling news, particularly on the trade front. We saw modest growth in imports, but still exports being a struggle. And that's news we had actually received yesterday. Yes, we are getting better domestic demand. We're seeing healthy elements. We're seeing some improvement in the supply chains. At the same time, exports seem to be struggling. There is hope in sight. And when we look at November's performance and we really think about the whole fourth quarter, this has been an impressive rally in two important sectors of the economy that gives us actually signs of improvement moving forward. First, mid-caps have done very well. They've crunched back a lot of the losses that they experienced this year. Performance so far this quarter running at 12%. We're comparing that to a decline 20% before this quarter started. So yes, helpful movements out of mid-caps and particularly in materials. The market has rotated. It's moved away from consumer-centric stocks. We're talking discretionaries, telecom, and technology, and it's focused now on more of the materials or the industrial base. What that's been a good time is for the market is that this has allowed and responded to the movement in precious metals. Why have precious metals moved? Yes, the international economy is not so good, but they're anticipatory. They're looking ahead to see how the economy is not going to be today and tomorrow. And that's why we've seen international equities move very strongly, and the dollar has been weakened. It's a completely different story than we had seen earlier this year, right? We'd seen the consumer-centric, the S&P be the driver of that. We've saw international weaknesses hitting lows after lows, and they really hadn't recovered a lot from the pandemic levels. Not surprising. Germany, issues with COVID, the war, inflation, fuel issues, and we even see that today. But it's worth noting that on the PMI, this is the Purchasing Manager Indexes, not just for the US, but for Italy and Spain. These are more peripheral countries, not the France, not the Germany and the EU, but as we saw in a sizable movement up, still in marginal contraction territory, but a slowdown of that contraction. There is some element of traction. The euro is higher. International developed equities are doing better. And this is actually can be a good sign as we get into 2023. The US has led the pandemic. We've had more fiscal stimulus, and through more fiscal stimulus, we have strong demand that continues to work in through the markets, that multiplier economic effect from stimulus. But if we start getting international, we start getting export demand for the United States, we start getting comfortableness with the energy situation, comfortableness with earnings, and with the inflationary outlook, that could be a very powerful engine for groups that had been weak. We have seen mid-caps be weak. We had seen international equities be weak. So this is actually a sign, a good sign, a healthy sign of rotations to the market. This is not a promise of performance, but it is telling us that internationally, the market has improved, the economies have improved, and with that, we may see support, even though worry is continuing to build domestically for a recession. We may actually have a wild card is international or global resurgence of growth. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.